Welcome to Satya Skills. In this video, I would like to share with you all one important concept relating to cooperatives. That is, why the Committee on Financial Sector Reforms neglected cooperatives, and also what impact it has on cooperative banking. In India, cooperative banks play a significant role in meeting financial needs of agriculture and rural sectors. Thus, they are also an important part of Indian financial system. But Narasimham Committee on Financial Sector Reforms neglected cooperatives. Narasimham Committee report on financial sector reforms has brought sea change in banking sector in India. The committee gave a series of recommendations applicable to the entire banking system, including regional rural banks, but not the cooperatives. Why it happened like that? Now let us look into probable reasons that cooperatives are not commercial organizations and are not a part of competitive markets. Cooperatives are the government supported units. They are more like instruments to distribute government aid. Cooperatives are under the state governments but not under union government. The policies and regulations of cooperatives vary from state to state in India. Thus, they cannot fit in the framework of reforms. In India, cooperatives are weak institutions. They are financially, operationally, and economically not viable. Majority of cooperative units, including DCCBs, are sick units. Cooperatives are poor man banks in India. But the role of cooperatives cannot be overlooked in India. Now let us look into the impact of reforms on cooperatives. We can say that, we can conclude that they are indirect and partly brought under reforms. Let us see what they are. Deregulation of interest rates gave freedom to cooperatives, especially to the district central cooperative banks, to determine interest rates on deposits and loans. This freedom was given with the expectation of making cooperatives economically strong, and also this will help them to expand business. They are given freedom to introduce new schemes which are viable and useful. NABARD has designed prudential norms for cooperatives. Their income recognition is based on record of recovery of loans. Unrealized income should not be considered into the profits of state cooperatives or central cooperatives. With regard to non-performing assets, if interest on agricultural loan is due for 2 seasons, it becomes non-performing asset. If it is a non-agricultural loan, interest due after 2 quarters will be non-performing asset. All loans which are not NPA are standard assets, NPA is substandard assets, and so on. They gave a big list. Necessary provisions are to be made for substandard and doubtful assets. Entire loss assets should be written off. After reforms, several new urban cooperatives were permitted liberally. These were some of the impacts on cooperative system. That's all in this video. All the best.